Welcome to TradeSpoon. My name is Vlad Karpel. I'm founder and CEO of TradeSpoon. And in the previous session, we talked about risk versus reward. Now I'd like to turn our attention on the topic of probability of success. If you're a stock trader, probability of success is 50-50. If you're an option trader, it allows you to buy stock at a discount. And if you buy stock at 2% or 3% discount, that means you increase in probability of success, meaning that the stock will not go against you for that percentage. So probability of success over 50% is a very important topic to make sure that when you trade options, you always keep in mind, what is my probability of success? And if you haven't done that, I encourage you to do that in order to become a better and more successful trader. So let's take a look at the mechanics. Probability of success. For TradeSpoon recommendations, when you go to our site, you see it as abbreviation POS, probability of success. Probability calculator is used to determine likelihood of stock reaching a certain price level by expiration date. This is what we mean by probability of success. We're looking at the supply and demand for options data in the money options by a certain expiration date. By looking at the option premium for certain expiration months, you can figure out what is the probability of stock reaching that level by that expiration date. So demand and supply of at the money and near the money options determine probability of success. High probability of success meaning trading strike prices further away from current underlying stock price. As you become more experienced trader, you'll realize that you want to trade options that give you the highest probability of success. That means you need to select a strike price that is away from where the current underlying stock is trading at. Probability of success at expiration is half of probability of success of touching your target price. What does it mean? It means that you do have to have a trading plan, and as soon as you reach your target gain, you should close your position and not wait for expiration. Why? Because stock market always reverts itself to its mean, if you look at the statistical term. If the stock, after the move in your direction, will revert to its mean, that means that the probability of stock being at the highest level at the expiration date is only half that probability of stock being at its highest when it reaches your target gain. So it's something to keep in mind that you should not wait till expiration, because probability of that the stock will remain at the elevated level in your favor reduces substantially as you approach closer and closer to the expiration. So at TradeSpoon, we have a probability calculator that you can see on your screen. Here you see an example of Edward Life Sciences, ticker EW, and it shows you that looking at the expiration date, we are trading usually 50 days away. Our optimal time horizon is 50 days. That's why you see on the screen time horizon of 50 days. So this means that in 50 days, Edward Life Sciences is trading at 131 right now, but in 50 days it will be as low as 113 and as high as 149. And that helps you with short-term strike prices selections. If you actually want to see whether you have a bullish or bearish or neutral bias, you can look at TradeSpoon short-term trend and buy and sell rating. Right now on Edward Life Sciences, you see in the screenshot, short-term trend is 10 and buy-sell rating is 10. That means we have a bullish bias. Based on that information, if you have a bullish bias and you've seen that Edward Life Sciences will sell, the probability of Edward Life Sciences selling out and reaching 113 level is only 12%, that you can see on your screen, then one of the strategy you can do is you can sell 115 put. Because selling 115 put, there's only roughly 12 or 14% chance, on your screen you see 11.88% chance that Edward Life Sciences will drop below 113. That means you have 88% chance that you will make money. So high probability of success meaning higher risk and low return on capital. As you become more and more experienced and active trader, you'll realize that you want to take high probability of success trades, but that comes at the price of low return on capital. When you start trading, you should take low probability of success trade, meaning that your risk is limited. You have a lower risk because you're getting higher return on capital. And eventually you want to kind of graduate from trading low-risk trade, taking on low-risk trades, and then as you get more experience and you know how to defend your positions aggressively, you can do a high probability of success trades. You can see more webinars on this topic if you go to tradespoon.com webinars page. We have webinar next week. Please review our page. And also follow us on social media. Thank you.